Okay, so you want to own real estate. You buy a property, you find a tenant, and every single month, without you lifting a finger, a check lands in your account. Do that a few more times, and suddenly you're not trading hours for dollars anymore. You're collecting rent while you sleep. Multiple properties, a growing portfolio, a life where money works so you don't have to. That's the dream. It's the version of real estate sold in seminars, in glossy Instagram posts, in books with titles that promise freedom by page 10. Most people believe that owning property is essentially a passive income machine. Buy it, rent it, collect. But here's the problem. That mental model is almost completely wrong, and the gap between how real estate looks from the outside and how it actually behaves underneath is exactly where most new investors lose money without ever understanding why. Once you understand what's actually happening beneath a rental property, everything else about real estate starts making sense. So let's take it apart, piece by piece. Start with the idea of rent as profit. Picture a landlord collecting $1,500 a month. Feels like income, right? Here's what almost nobody notices. That number isn't profit, it's revenue, and revenue has obligations standing in line in front of it. The mortgage payment gets paid first, then property taxes, then insurance, then a slice for maintenance that hasn't happened yet but eventually will. Then a reserve for the months the unit sits empty because tenants leave and finding a new one takes time. By the time all of that is subtracted, what's left often isn't a windfall. Sometimes it's barely anything. Sometimes it's negative. Think of a rental property less like a vending machine and more like a small factory. A factory generates revenue too, but nobody assumes a factory is pure profit the moment products roll off the line. There's equipment to maintain, workers to pay, energy costs, downtime. A property is the same. It's an asset that produces income, but only after running its own operating costs. Miss that distinction, and you'll mistake a fragile business for free money. Now here's where things become interesting. If cash flow isn't the real engine of wealth in real estate, what is? The answer is leverage, and it's the single most misunderstood force in this entire industry. Picture buying a $300,000 property, but you only put down $60,000. The bank supplies the rest. If that property rises in value by 10%, you didn't gain 10%. You gained 10% on the full $300,000, which is $30,000, against your original $60,000. That's a 50% return on your actual money. This is leverage, and it's the closest thing real estate has to a lever in the literal sense. A small amount of force at your end, producing an amplified result at the other. But remember this, because it becomes important later. Leverage doesn't just amplify gains, it amplifies losses in exactly the same way. If that property drops 10% instead of rising, you haven't lost 10% of your money. You've lost 50% of it. The lever swings both directions with equal force, and most people only picture it swinging up. This is exactly what happened during the 2008 housing crash. Homeowners and investors across the United States had used leverage to buy properties with very little money down, riding rising prices for years. When prices reversed, the same mechanism that had multiplied their gains multiplied their losses just as violently. Millions of people discovered that equity they believed was permanent could evaporate in months because it was never really theirs alone. It was borrowed value, dressed up as wealth. Here's another layer underneath this. Every month you make a mortgage payment, something quiet and easy to miss is happening. Part of that payment goes to interest, and part goes to paying down the actual loan balance, called principal. In the early years, more than half of every payment goes toward interest, not equity. Hold on to that number, because it explains something important later. As the years pass, that ratio flips, and more of each payment starts chipping away at the loan itself, building equity, dollar by dollar, whether the property's value moves or not. This is often called forced savings, and it's one of the quiet reasons real estate builds wealth over time, even when nothing dramatic happens. Your tenant's rent is functionally paying down your loan for you. Every year that passes, you own a little more of an asset that a bank still partly owns, without you having to do anything except keep the property occupied. It's slow, it's unglamorous, but it compounds. There's another layer underneath this, and almost nobody talks about it because it doesn't show up in a monthly bank statement. It shows up once a year on a tax return. Tax authorities allow property owners to deduct a portion of a building's value every year as depreciation, treating the structure as if it's wearing out, even while, in reality, its market value might be climbing. That deduction can offset rental income on paper, sometimes turning a property that's genuinely profitable into one that shows a loss to the tax office. Read that again, because it sounds almost too convenient to be true. It isn't a loophole in the shady sense. It's a deliberate policy choice designed to encourage private capital into housing. Investors who understand it treat it as a second, quieter income stream, one measured in taxes never paid rather than checks received. Now let's look at what actually happens when you combine these two forces together: leverage and amortization. This is the real economic engine behind property wealth. It's not the rent check. It's the fact that you control an asset worth far more than your own capital. That asset is historically, over long periods, rising in value, and every month a portion of someone else's rent money is converting borrowed debt into owned equity. That combination, working quietly over 10 or 20 years, is what actually builds the fortunes people associate with real estate, not the monthly cash flow, the structure underneath it. But that's only part of the story. Think about what an iceberg looks like from the surface. You see a modest, manageable shape above the water. Underneath, there's a mass 10 times larger, invisible until you're already close to it. A rental property works the same way. The purchase price is the visible tip. Below the surface sits closing costs, inspection fees, a new roof in year 7, a broken furnace in year 12, months of vacancy between tenants, property management fees if you're not doing it yourself, and legal costs if a tenant dispute ever escalates. None of these show up in the glossy pitch. All of them show up eventually in the numbers. Here's what's interesting. None of that is the biggest risk. The biggest risk is one word: liquidity. Sell a stock and the money is in your account within a couple of days. Sell a house and you're looking at months. Agents, inspections, negotiations, and a buyer who might walk away at the last minute. That difference matters most in exactly the moment you'd want out. During downturns, when jobs disappear and rent checks slow down, real estate can't be turned into cash quickly to cover the gap. Picture two investors going through the same recession. One holds shares he can sell in an afternoon if he needs to cover an emergency. The other holds a duplex, fully leveraged, with a tenant 3 months behind on rent and a market where nobody's buying. The property might be worth just as much on paper, but paper value doesn't pay bills. That mismatch, wealth that looks solid but can't move fast, is what actually breaks over-leveraged investors far more often than the property losing value. Here's what's interesting about the people who actually succeed at this. They're not the ones chasing the highest rent. They're the ones who plan for the iceberg. They keep reserves. They underwrite deals, assuming higher vacancy and higher repair costs than they expect. So that reality, when it inevitably disappoints them slightly, still leaves them standing. This becomes especially clear when you look at what happened after the 2008 crash. As millions of individual homeowners were losing properties to foreclosure, large institutional investors, including firms like Blackstone, began buying up thousands of single-family homes at steep discounts, eventually forming companies like Invitation Homes. The mechanics were identical to what any small landlord faces: rent, maintenance, vacancy, leverage. The difference was capital reserves, scale, and patience. The exact same asset class that had wiped out over-leveraged individuals became one of the most profitable trades of the following decade for those who had the structure and the staying power to survive the volatility underneath. That's the hidden truth sitting beneath this entire subject. Real estate was never actually about buying a building. It's about controlling a leveraged, illiquid asset over a long enough period of time that the quiet mechanics working underneath it, debt paydown, appreciation, and yes, occasional cash flow, outweigh the very real costs and risks sitting below the surface. Once you see it this way, the whole picture reorganizes itself. The dream of passive income was never wrong, because passive income doesn't exist in real estate. It was wrong because it left out the machine entirely: the mortgage, the maintenance, the vacancy, the leverage cutting both directions. What's left, once you understand the machine, isn't a shortcut to freedom. It's something more honest, and in some ways more valuable. A long, patient bet on ownership itself, where time, structure, and discipline matter more than the size of the first rent check. And maybe that's the real lesson real estate has to teach, one that reaches far beyond property. It isn't really a lesson about houses or tenants, or interest rates. It's a lesson about how ownership itself actually works, in any form it takes. Every asset that promises to make you money while you sleep is quietly asking you to absorb risk while you sleep too. And the two are never separable, no matter how the pitch is framed. Wealth was never built by finding something that pays you for doing nothing. It was built by understanding a system well enough and respecting its risks enough to survive them long enough for its quiet mechanics to finally start working in your favor.